Risk-reward ratios are one of the deadliest traps in trading. They take what would have been a profitable trader and turn him into a highly disciplined loser. The problem is that almost everyone gets it wrong. The advice they follow is exactly what's destroying them. It sounds like it makes sense, which is what makes it so dangerous. Because once I peeled back the layers, I realized how far it was holding me back. I realized everything I believed about entries, stops, and targets had cost me years of progress and an unthinkable amount of profit. It wasn't because of my execution, and it wasn't because I was lacking discipline or anything. It wasn't even psychology. It's because I was trading completely backwards. And no amount of discipline or psychological work is going to help you if you're going in the wrong direction from the start. I was doing what everyone else was doing because I assumed it worked. But now I just do what actually works. And my results took off. So in this video, I'm going to show you exactly why the most common advice works against you and how to actually use risk-reward the right way to grow your account. And just a quick disclaimer, none of this is financial advice. I'm just showing you what works for me. If you choose to use it, do it responsibly and size correctly. Welcome back to the channel, and if you're new here, this is where we stop trading nonsense and instead trade what actually works. This one is particularly important because risk-reward is one of the two main components of profitability. You simply can't stay profitable if your risk-reward is stacked against you, the same way you can't stay profitable if your win rate is too low. It's simple math. You need one of two things. Either you win often, or when you do win, you make way more than you lose. If neither of these is true, you have no edge. Being profitable is mathematically impossible. And yet both of these are highly misunderstood and not being used correctly at all. I already did a deep dive into how to improve your win rate, which I'll link here for you to watch later. But when it comes to risk-reward, traders are given horrendous advice, to the point where it might as well be sabotage. There are two core ideas traders are taught, and both of them are backwards. Number one is that your risk-reward should be based on your entry or your stop loss. And number two, which is even worse, is that your risk-reward should be based on a certain number or ratio, like let's say a 2-to-1 or a 3-to-1. I see number one happen all the time. A trader might be looking for a trade in a certain direction and then see that the price moves against them. So now they're thinking, well, if I enter here, I could get a really good risk-reward. Instead of waiting for confirmation and the right structure, they're thinking about their risk-reward first. And of course, this usually doesn't work in their favor. Or they might enter a trade and know where they should set their stop, but they don't like the way their risk-reward looks. So they artificially tighten the stop. And on paper, it looks great. But in reality, the market isn't that easy. More often than not, this backfires completely and tanks your profit. And this gets traders confused because they think their idea was wrong. But it wasn't their idea that was wrong. It was their framework. They didn't get stopped out because the trade failed. They got stopped out because they tried to manufacture their own risk-reward. Having a tight stop doesn't magically create an opportunity, and a better entry doesn't mean a better trade. What you're doing here is prioritizing the wrong things. Then you start getting obsessed with sniper entries, or having a very tight stop or a large target. You're thinking about how clean the trade would look instead of asking if it's even a valid idea in the first place. And that brings us to the second core idea, which is that your risk-reward should be a certain ratio. I see this advice all the time. You hear things like, your trade should be a 3-to-1 risk-reward at least, or something similar. And when you hear that, you should just ask yourself, why? Because approaching the market like that will, number one, make you miss some excellent profitable trades that had a lower risk-reward. And number two, it'll make you force things that aren't there. Because, let me be clear, and this is something extremely important to remember, the ratio itself does not create the edge. The edge creates the ratio. The market should define your risk-reward, not the other way around. So let's say you have a good trade idea, but you entered it a little bit late. Now your risk-reward that was originally a 2-to-1 is a 1.6-to-1. The right thing to do here would be to let the trade play out anyway. But if you've been told that you need a certain risk-reward, you'll modify your target to fit that ratio. And guess what? It usually doesn't pay off. Because think about it. Your first trade was based on objective analysis of the market. Your stop and target were based on structure and on where the price would flow. But your modified trade is based on your own entry. And the thing is, the market doesn't care about where you entered. It will move where it needs to move regardless. Do you really think the market looks at your entry and says, you know what, I was going to reverse at this point, but he needs to hit his 2-to-1, so I'll hit it for him? No, of course it doesn't. The market doesn't bend to you, and a lot of advice about finding these high-risk reward trades is complete nonsense. They talk casually about a 3-to-1 trade as if it's something that happens all the time. But do you realize how hard it is to find a clean 3-to-1 trade repeatedly? I mean, sure, I've hit 3-to-1 trades and even higher in my own strategy, but it's rare. If it was the only thing I was looking for, I'd be very disappointed. 3-to-1 trades are extremely profitable. You only need a 25% win rate to be profitable with them. So the market is not going to give them out like candy, and you should expect a very low win rate. That's the part they don't tell you. They'll give out advice that sounds good instead of advice that actually works. And that's exactly why I don't trade with ratios at all. I don't even think about them. I just trade what the market offers me, and that's what actually gets results. So how do we actually trade what the market offers? Well, let me show you. Most of this risk-reward advice comes from either a lack of understanding the market or overcomplicating it. And overcomplicating the market is just a lack of understanding the market as well. So really, it comes down to not understanding the market deeply enough. Now, the market isn't easy to trade by any means, but it's not as complicated as it looks. What is complicated is all the noise layered on top of it. All the endless setups, patterns, rules, ratios, and indicators that promise to make you profitable. But when you strip that all away, the market really only does one thing. It moves from one point of interest to another. It will pause or react at these points. And it either has room to continue in that direction, or it doesn't, and will move back where it came from. So trading what the market offers isn't about predicting anything. It's about correctly identifying a flow and jumping in with it. This is what I call the LCE model, where LCE stands for level, confirmation, and execution. That's where we map out levels of interest, then wait for the price to reach one of those levels, then take a trade to the next level. This is a reliable and repeatable process for consistent trades, and it works in any environment. You're trading from one level of interest to the next based on how the market actually moves, not on arbitrary numbers or forced ratios. Now, to be clear, I don't share everything I know on YouTube. The deeper mechanics on how to apply this are inside my LCE accelerator. This is where you can work with me one-on-one. You have weekly group calls, a private chat with me, access to my exact chart, and a community of traders who keep you accountable. If you're interested, the link is below. But for now, let's break this down. When the price enters a level, all we need to do is make one decision. Will the price move to the level above or the level below first? We need to get the direction right before anything else. And for this, we use the cloud. The cloud will smooth out price action and give us a clear picture of where the price is trending. If it's pointing one way, it usually means the price is more likely to move in that direction. That's how we determine whether to go long or short. And that's where our win rate comes from. It depends on how well we can read the cloud and how often we can get it right. A 50% win rate is standard if you're just guessing randomly. But if you read and use the cloud properly, you could bump that way higher. Now, once we determine our direction, our risk reward comes from where we enter, place our stop, and place our target. And for this, we have a relatively simple rule of thumb. We want to enter somewhere in the middle of our level. It doesn't have to be super precise, as long as it's in the right direction. We want to place our stop somewhere halfway between these two levels, preferably behind some kind of market structure, and we want to place our target right at the next level. If we do this properly, we'll get a risk reward of roughly 1.5 to 1 or 2 to 1 most of the time, and possibly higher. Combine this with a win rate above 50%, and we have a profitable strategy, and it's one that can stay profitable and improve consistently. Now notice how I don't have a specific risk-reward ratio or modify my trade around it. I set my stop and target based on market structure. Whatever risk-reward that happens to be, I'll take it. If I enter a little bit later and only get a 1.2 to 1, I'm not going to modify my stop or my target just to make it look nicer. Sometimes you'll get in early and sometimes you'll get in late. You won't have the perfect trade every single time. That's just the reality of this business. It's not a highlight reel. What's important is that you stay consistent and continue executing to let your edge play out. And that's really the key thing I want you to take away from this. Risk reward isn't something you force. It's something you accept based on what the market is offering. If you stay disciplined with the process and manage your risk properly, the results take care of themselves over time. And if you want to see the LCE method work in the real market, I have a few videos where I backtested in real time. I'll link those here for you to watch later. Be sure to check out the LCE accelerator in the description. And if this video helped you, be sure to leave a like, subscribe, and turn on notifications. I'll see you in the next one.